Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again the most frequent guest on this show, Michael Oliver. And Michael, I would encourage you to go to his website at Oliver MSA, Oliver, M as in Mary, S as in Sam, A as in Albert.com, Oliver MSA, to learn more about his work. And I suggest you do that because I hold it in such high esteem. And of course, that's one of the reasons, that is the reason that Michael is here with me more frequently than anyone else. Thanks for joining me again, Michael.
Great to be back.
You know, the world is expecting a rate hike tomorrow. I think it's, I saw on CNBC, they're suggesting 95% certain, or at least 95% of the economists there are suggesting that we'll get one. It'd be the first rate rise in some 7 years or so. Now, normally a rate rise would be considered bad news for equities, and, you know, somehow, though it seems today the markets aren't paying much attention. In fact, they rather think that maybe there's good news now. The Fed knows in its omniscience, it knows that the economy is really strong, and if the Fed is raising rates, we can just trust it and go out and buy stocks like there's no tomorrow. But of course, you don't look at these fundamental things so much in this, you know, hearsay and hoopla that you hear on. You're really looking at the structure and the momentum of markets. Can you help us set aside the verbal diarrhea, I would call it, from the Fed officials and other talking heads to help us understand the overall structure? What are you seeing in the equity markets? You know, I would like to mention that to my listeners that on December 11th, you put out a very interesting piece. It was titled "A Chart to Nail to Your Trading Room Wall." And there you provided some ideas about what some of the breaking points might be for the S&P going forward. Can you give us a sense of where do you see the S&P right now?
Well, I see it as having transitioned into an early bear market. And recall 2007, for example. Up, down, up, down, up, down, with no real direction. It finally ended up closing in the middle of the year's range, and then it was bombs away in 2008. That was a transitional year, and it consumed the entire year. Mm-hmm. Well, what's happened here? I mean, the same thing. S&P's down on the year about 0.5%. It's been up and down on the year, probably more down on the year than up, but still just a big sloppy range of action. Very little liquidity, but apparent distribution. Somebody doesn't believe in it. Mm-hmm. And they stopped where I thought they should stop, which is 2130, and they just keep, and that crowned the year twice. And I since then we haven't fallen apart, so nobody sees an overt bear market yet. Mm-hmm. So from a momentum perspective, I measure price action against certain means, averages, mm-hmm. Long-term averages, short-term, and so forth. Well, the emphasis is, of course, on long-term right now, and mm-hmm. I'm looking at three-year average, 36-month, and 200-week averages. Not crossing the average itself, but the structures that are built when you plot price against those averages, you end up with an oscillator. Mm-hmm. The oscillator presents a bar chart picture just like a price chart, but it doesn't look like the price chart. Mm-hmm. And it gives you different information about where is support and resistance. And we violated enough stuff this year and put ourselves in a position so that when we open next year, we will be blowing out other supports of great consequence on the momentum charts. Now, this is not just true with the S&P. It's true with the DAX index in Europe. It's true with the Euro Stoxx 50 index, a blue-chip index of Europe. It's true with the Nikkei 225, another developed market index. They're all in the same boat. They've all been wounded, and they're all waiting for next year. And when we open next year, they're not in a good position to have a good year. They're in the starting gate position to go down. So I think we're in transition for downside in stocks. I think an inverse of that's occurring in some other markets, commodities in general, although they still have not quit going down. Some of them have not. A lot of them have. And so I think it's a big arm wrestling match that is basically going opposite directions to what you think you see on a price chart.
Okay. I'd like to get to some of the commodities and in particular the precious metals in a moment. But one other thing I'd like to ask you about, I noticed that another technical analyst that I follow pointed out yesterday's rally in the markets. There was more losers than winners. I think more stocks were down than up. And you pointed out, I think, this sort of narrowing of breadth. The market there's fewer and fewer stocks that are sort of leading the charge, and that is sort of typical. I think you see that in near long-term bull markets. But you had a very interesting piece you put out on discussing the internet stocks in particular. I think there's an ETF That's PNQI, I think is the symbol.
That's correct.
It includes includes stocks like Google, Amazon, Facebook, and Netflix. I guess those are the stocks that are in there.
Those are the kings right now. Yeah.
Those are the kings. Yeah, I mean they are really pulling the market, keeping it from tanking, I would argue. But
right.
What are you seeing in your analysis of that ETF, Michael?
I think the ETF is topping out. It topped, for all intents and purposes, from an investment point of view, in 2014, and it went into a range. The market persisted in going up. It didn't. It actually got hit very hard in early 2014, and it took it an entire year of recouping to finally, in the middle of this year, exceed the 2014 high. And of course, that's when you had the big explosion in Google and Amazon and all of them, almost on the same day. Mm-hmm. So we've made a, quote, new high in the PNQI, and these stocks are stellar, and they're heavily weighted in the NASDAQ 100, which of course gives the NASDAQ 100 the big edge. They're not equally weighted to other stocks in the index. But it's that narrow now to where those four symbols and a few others, which constitute the bulk of the PNQI ETF as well, make the PNQI the focal point as far as I'm concerned. It's easy to find the weak components of the market, see the market's weak. The key, I think, is to find the strong ones and nail the point where they turn down. Because when that happens, that's when the market caves. And so I'm watching the PNQI. It's trading around 81 right now. There's some massive numbers underneath it next year. They're down in the 70s, low 70s. But you got to remember, that's about where the highs were during the 2014 period when it peaked and went sideways and finally worked itself up another $10 into the 80s. If you drop back down to 72.5, that looks to me like a major top completed and a major decline ahead. So that's down there a bit, but for a volatile ETF like that, it doesn't take a lot to get down there. So I am focused on that particular ETF.
All right, good tip. Well, we'll have to keep our eyes on that particular ETF. Some fundamental analysts are pointing out that the demise of junk bonds is the start of possible breakdown in the financial markets. So today, however, I see that junk bonds are rallying along with stocks and everything else. What is your outlook with respect to junk bonds now? Are you see? I think we talked about the high yield markets in the past. Are they've broken through? Are you really definitively bearish now?
MSA turned negative several quarters ago, and it was a slow start. In other words, the downside in the HYG and the JNK ETFs was arm wrestling type of downside. It wasn't precipitous. It didn't scare anybody. It's only recently that you're starting getting the downside volatility, and of course you get an update. It's going to be a big one. That's the way it is. I don't see any reason, from my perspective, a momentum structural perspective, to assume that a bottom's been reached or that we're even near a bottom. And that doesn't mean it can't bottom despite that, but I don't see the technicals that say, hey, you're near a bottom. If anything, I think we're in mid-stride. And I do think the contagion will roll over. And again, it's one of the two that was put up there by central banks. They wanted you to buy high yield and invest, not save, and the public did it. The public did quite well between 2011 and 14 on those type of vehicles. Now suddenly the public's bleeding. Now they're not bleeding in their stocks yet, but they're certainly getting hurt in the high yield market. And it's not just oil related. There's a lot of property related ETFs and symbols that are getting crushed as well. So you can't blame the high-yield debt market just on the whatever 12% or so of it that's energy-related. It's a contagion beyond that. And yes, I do think it'll roll over into the equity markets.
Oh, and then as I was saying in my introduction, there's some evidence now that a lot of the stellar companies, the companies that that have the highest credit ratings, are starting to have weaker balance sheets because they borrowed so much money to buy their own shares and stuff too. So you have to wonder, to what extent there might be a general weakening overall of the credit markets. But we'll have to certainly keep our eyes on that. Now, you mentioned oil. How does oil? Oil's had a second good day today so far, at least when I looked earlier today. The equity or the oil stocks were up strongly, and oil also was up a good bit today after yesterday. where are we at in oil? We've seen the bottom there yet,
well,
you think?
Oil and oil stocks, I think you need to differentiate. First off, it's clear that the oil stocks have gone down hard while the stock market went sideways during 2015. So that was a function of a weak oil market. However, I argued in a recent report that you could also have the opposite, and I think it will occur. And that is where oil finally does make a low, and I'm not talking $20. I'm talking either side of the low 30s, let's say 32. Mm-hmm. The recent low just above 34 is I'm not particularly keen on it. I'm not looking for 20, but I do think oil is trying to find a bottom, and I suspect it will find one in Q1 of this coming year, and not at some disastrous level. And that does help XLE, the energy sector ETF, and so forth on days like today. But when I look at the XLE, it does not look to me to be at all complete on the downside. And it's an ETF that's trading in the low 60s right now. My bet is you see it in the very low 50s before you might then be at a low. And I suspect that low will occur simultaneous with the next sharp low in the S&P. In other words, it's not a function at this point all the way of just what oil does that will cause XLE to move up or down, but what the broad market does. So, for instance, let's say oil does find a bottom, but doesn't explode. It subtly moves up off of its low in a begrudging way, let's say.
Yeah.
The key then is the S&P. If the S&P goes for a dive, I think that will put the damper on the XLE and drive it down, because they're stocks. They're a key part of the S&P. So the S&P will then become the negative driver for the XLE. Mm-hmm. And during that process, though, I do think you'll find this situation develop, and it'll be a tell that the XLE won't go down as much as the S&P at that point going forward. Mm-hmm. So it'll be time where it'll be better to own energy stocks than the S&P starting from around that low. Next major low.
Yeah. Okay, well that's good. That we'll have to keep our eyes on that. And one more thing before I let you go, we can't let you go without at least a comment or two on gold. When, Michael, are we going to see a bottom in gold?
Next year. These are numbers I'm looking at. I still think the gold is bottoming. It's a gradual eking down process. The collapse occurred in 2013. Everything since then is another 10% or so below that level, but it's taken us 2.5 years to lose that 10%. So put that in perspective. Silver as well. Next year, if you ever see gold in the 1150 to 1170 zone, that is a massively positive zone to get into. It doesn't show up in a price chart as important, but from long-term momentum it says you've won. It's turned. In the case of silver, if I see a monthly price close just short of $15 in the upper 1490s, I think you can circle that monthly close and say that's it, silver has bottomed. Now, we've been there in the last month or so. So we're talking about price levels that we've seen during the past 30-some-odd trading days, especially on silver. So those are the numbers I'd be watching as of 2016.
All right, Michael. Well, it's gold isn't that far away either. I mean, $100 from where it is now will get us into that range. So, yeah, it will. It really could. I mean, it's of course it's the paper markets, and God only knows how much more paper is going to come at the physical markets. But that's another story for another day. Ultimately, as you point out, markets do prevail. It's just the question is whether or not we can live long enough to see it, I guess. But I think we will. You and I aren't that old yet, Michael. So
I think Janet Yellen has more to worry about than we do.
Okay, I think you're right. I wouldn't want to be in her shoes. That's for sure.
Absolutely not.
All right. Well, thank you very much, Michael, for being with us once again. Your insights are always cherished, and always a pleasure to have you with us. So look forward to doing it. Hopefully next week again. All right. Thanks.